I realize this is one of the first occasions to meet people in person and to chat up friends you haven't seen for a long time. But I wanted to encourage people, please, to come in so that we can start with only a few minutes of delay. So slowly, I think this is happening. I lost one of my panelists to exactly that activity.
Is Monika there? Have you checked?
Ah, yeah. Monika Piazzesi, are you connected? Can we have a sign of life from her?
Hi. Hello.
Okay, Monika. Perfect. Great. Thanks a lot. Okay. Okay, so I see that the volume of bilateral discussions is slowly dying down, and therefore wanted to invite you to this session number 2, or debate actually number 2, on monetary policy and climate change. The structure will be the same as before. We will first have 3 speakers, Isabel Schnabel, Monika Piazzesi, and Hans-Peter Grüner. And having the privilege of being the chair, I allow myself to perhaps make the questions which I would like to see addressed a bit more concrete. And one question which I find interesting is the following. There has been a lot of discussion of whether monetary policy should take into account climate change or not. But my question would be, if you decide that that should be the case, how would you measure the success? What would be a successful monetary policy that takes into account climate change look like? Is there something that you can grasp on? And the second point, I think, which is more circumstantial, is that at least until about, I think, 1 year ago, we had here in Europe already a European emissions trading system, but with a very low carbon price. And therefore, the argument was always, the system is not really working, it doesn't price the externality properly. And my question to the panelists and to everybody would be, now that has changed, right? Can one argue that the externality is now properly taken into account, at least for some sectors, by the market? So that's it for my side. And the first contributions are, of course, from Isabel Schnabel, from the European Central Bank, as you all know. And I think we all know her many academic and other qualifications, and actually her contributions to this topic already earlier this year. And therefore, without further ado, Isabel, the floor is yours.
So thank you very much, first of all, to Volker and his team for inviting me to this distinguished panel, which unfortunately has gained further relevance by the Russian invasion of Ukraine. Today, our dependence on fossil energy sources is not only a peril to our planet, but it is also a threat to our freedom. The horrible war in Ukraine has made one thing clear. We need to accelerate the transition towards renewable energies as much as possible. Already today, electricity from renewables is significantly cheaper than that of conventional power plants. Once a larger share of our energy demand can be met with renewables, households will benefit from lower prices. But the transition to this new steady state will not come for free. And it brings about challenges for monetary policy. As we build a more sustainable economy, we face, and this is the title of my speech, a new age of energy inflation with 3 distinct but interrelated shocks. The first is linked to the costs of climate change itself, or climateflation. As the number of natural disasters is rising, so is their impact on economic activity and prices. For example, exceptional droughts in large parts of the world have contributed to the recent sharp rise in food prices. The second shock, which I call fossilflation, reflects the legacy cost of our dependency on fossil energy sources, which in 2019 still accounted for 85% of total energy use in the euro area. My first slide shows that in February, energy accounted for more than 50% of headline inflation in the euro area, mainly reflecting the sharp increases in gas and oil prices. While the fight against climate change is contributing to higher fossil fuel prices, it is not the main driver. Indeed, the left-hand chart of this slide demonstrates that an overwhelming share of the recent excess rise in gas and oil prices over and above their pre-pandemic levels reflects the ability of energy producers to steer supply in an oligopolistic market. These are the red bars. The European Commission's plan to reduce Russian gas imports by 2/3 by the end of the year means that fossilflation can be expected to remain an important contributor to inflation in the foreseeable future. The third shock is greenflation. Most green technologies require significant amounts of metals and minerals. Electric vehicles, for example, use over 6 times more minerals than their conventional counterparts. Yet, as demand rises, supply is constrained. It typically takes 5 to 10 years to develop new mines. This imbalance is why the price of many commodities has increased measurably in recent months. The chart on the right-hand side shows that the price of lithium, for example, has increased by more than 1,000% since January 2020. These developments illustrate an important paradox. The faster and more urgent the shift to a greener economy gets, the more expensive it becomes in the short term. So far, greenflation has had much less of an impact on final consumer prices than fossilflation. It is therefore misleading to blame the greening of our economies for the painful rise in energy prices. But during the transition to a greener economy, greenflation will contribute to inflation as more and more industries switch to low-emission technologies. So, how should monetary policy respond to these price pressures? Concerns have been voiced that monetary policy could slow down investments in green technologies if it removes monetary stimulus. 2 concrete proposals have been put forward as to how central banks could look through higher energy price inflation during the green transition. The first proposal is to raise the inflation target. A higher target would automatically reduce the need for policy adjustments. Last year, as part of our monetary policy strategy review, we carried out an in-depth assessment of our inflation target, and we decided against a higher target, mainly for 2 reasons. First, there is considerable uncertainty as to whether the secular decline in the real equilibrium interest rate, which would speak in favor of a higher target, will continue in the future. In fact, the significant need for green investments may lead to a rise in real interest rates from their subdued pre-pandemic levels. This slide shows that the energy transformation alone requires a doubling of global annual investments. Second, if central banks decided to move their goalposts when they fail to achieve their target, they would almost certainly lose credibility and public trust. It would undermine the anchoring role of any numerical target. So, just as central banks have not succumbed to pressure to lower their inflation targets in the decade before the pandemic, they should be very careful in raising their target at a time when the green transition may loosen the binding constraint of the zero lower bound and lower energy prices over the longer run. The second proposal suggests setting monetary policy with a focus on underlying or core inflation. There are two main problems with that idea. First, exclusion-based measures remove the most volatile items because prices that fluctuate are less relevant for inflation in the medium term. The green transition calls for different treatment of energy prices precisely because changes in these prices may become less symmetric during the transition, as imbalances in the energy and mineral markets limit price movements to the downside. An inflation index that ignores a persistent increase in the relative price of energy is a misleading indicator of underlying inflation trends. Second, there is a reason why the ECB focuses on headline inflation. It is a comprehensive measure that effectively protects people's purchasing power. Permanently excluding items from this index would ultimately serve to undermine trust in our determination to protect price stability. This does not mean that the concept of underlying inflation will become less relevant for monetary policy in the future. It just has to be defined differently. For example, the PCCI, or Persistent and Common Component of Inflation measure, exploits common movements rather than excluding certain items. It thus also captures the impact of more persistent shocks to food and energy. The left-hand chart of my slide shows that the PCCI has signaled an increase in underlying inflation earlier than other measures. Overall, therefore, monetary policy cannot simply ignore the effects of the green transition. The chart on the right-hand side shows that already today, we are seeing that firms are passing on higher energy costs to final consumer prices, thereby contributing to a notable broadening of price pressures. Such indirect effects of higher energy prices are often not just a one-off shock. In particular, when pipeline pressures are continuing to build up, like today. Nominal rigidities, long-term supply contracts, and global value chains imply that the lags with which higher input prices are passed on to consumers are long and variable. All this means that when it comes to advancing the green agenda, fiscal policy needs to remain in the driving seat. It is essential that the euro area's revised fiscal framework creates space to speed up green public investments. Fiscal policy also has an important role to play in buffering the current supply shocks by protecting those suffering the most from higher energy prices, while, importantly, retaining incentives to reduce carbon emissions. That said, the ECB can and will do three things to support the green transition. First, the distinction I made earlier between different types of shocks matters for monetary policy. Climateflation and fossilflation are adverse supply shocks that require a finely balanced policy response. On the one hand, prudence is needed as aggregate demand is already suffering from higher energy and food prices. On the other hand, such prudence may come at a cost, especially when the inflation outlook is no longer consistent with maintaining the exceptional policy measures we took to fight very low inflation. A reaction function that differs materially from that of other central banks risks amplifying the energy price shock by putting downward pressure on the exchange rate, thereby adding to the burden on real household income. Since June of last year, Brent crude oil prices have increased by around 45% in US dollar terms, but by more than 60% in euro terms. Therefore, as we announced at our meeting last week, monetary policy normalization in the euro area will proceed, but it is going to be gradual and conditional on the war not weighing on medium-term inflation. Only signs of a de-anchoring of inflation expectations from our target would justify a more forceful policy response. We have not yet seen this in the euro area, but we are carefully monitoring the recent rise in long-term market-based measures of inflation compensation above 2%, shown on this slide. Second, we will continue to green our monetary policy framework. Our goal is to ensure that our instruments, such as our asset purchases or our collateral framework, are aligned as much as possible with the Paris objectives. Take our corporate bond holdings of around 380 billion euros as an example. While we intend to reinvest maturing securities for an extended period of time after policy rate liftoff, we could actively tilt our portfolio towards the Paris objectives once we have decided on how the market neutrality principle should be modified. For other potential instruments, like green TLTROs, we still have to overcome operational impediments. Many banks, for example, do not yet effectively differentiate between green loans and other loans. Third, we need to strengthen our joint efforts to green financial markets. Monetary policy is a cyclical policy. It cannot provide structural support to the green transition. Financial markets are different, as they can provide a permanent platform to channel finance towards greener projects. Central banks have an important role as catalysts in greening the financial system. For example, the euro system could impose a limit on the assets from high emitters that can be mobilized as collateral. Over time, such changes affect the entire collateral pool held by Eurosystem counterparties. My final slide shows that the efforts made by us and other institutions to green financial markets are showing first results. The left-hand chart illustrates that the green bond market is growing quickly, while the right-hand chart shows that the greenium, that is the premium investors are willing to pay for a green bond, has become statistically significant. A financial market that better internalizes the costs of climate change will provide strong incentives for green investment, even when monetary policy is normalizing. Summing up, the measurable increase in euro area inflation and the horrible war in Ukraine remind us of the urgency to accelerate the green transition. However, moving away from fossil fuels as fast and as forcefully as possible will not come without costs and will herald a new age of energy price inflation. Monetary policy will play its role in this transition. It will protect the purchasing power of people by ensuring that the current protracted period of high inflation will not become entrenched in expectations, while remaining supportive of growth and employment. And to directly answer to Daniel's first question, how do you measure whether we are successful? Just look at price stability, whether we achieve our mandate of price stability, because this is our main concern. Thank you.
And thank you in particular for your very forceful answer to my impertinent question. I think we all understood what you meant by that. Now it's the turn of Monika Piazzesi. She's at Stanford University, and for those who follow her work have seen that she has made some very concrete proposals how monetary policy could and should take into account climate change. And Monika, the microphone is yours, and I hope we don't have any technical glitches now. Go ahead.
Thank you very much, Daniel. I'm very excited to be here on this panel with Isabel and Hans-Peter, two economists that I deeply admire, and I'm looking forward to our discussion. So this is a panel about climate change. And so here, The question is, in the low interest rate environment that we've been in, the main tool for monetary policy has been asset purchases. Governments have been buying bonds, government bonds, mortgage-backed securities, and most recently corporate bonds. The goal of these purchases has been to lower firms' cost of capital and thereby stimulate investment. And so, of course, the question becomes, which government bonds should central banks buy? The conventional view on this is that monetary policy should aim for market neutrality. The reason is that there's no mandate to favor any particular firms in the economy. In practice, this idea has been implemented by doing bond purchases proportional to the value of bonds outstanding by different firms. And so what I'm going to talk about today is show you plots of what the ECB has been doing so far. So what is the current corporate bond portfolio of the ECB? This goes back to work with Melina Papuzzi and Martin Schneider. Melina is at the ECB. And then I'm going to ask, how do these purchases actually work? How are they supposed to work? How are they supposed to stimulate the economy? And can they be neutral? So what would be a concept of market neutrality? And then I'm going to talk about the impact on climate and show you some ballpark numbers of this research. So here's what's happening, what the ECB has been doing. So first, let me show you the market portfolio of the euro area. So these red bars on the horizontal axis, you see the share of the value of firms in the various sectors. So this is the market portfolio. So how much these firms are worth as a fraction of the total. And you see the various sectors on the vertical axis. You see agriculture, automobile. There's a large sector of manufacturing where we group the subsectors of manufacturing that have high emissions, like oil and coke, chemicals, basic metals and non-metallic minerals, and other manufacturing. Then you have utilities, transportation, and then you have the service sector. And like all modern economies, the euro area has the largest share of firms in the market belongs to the service sector. So this is just the value of firms in the economy as a share of the total. Here's the fraction of the ECB portfolio of corporate bonds that is held in the various sectors. So you see that the ECB holds corporate bonds issued by firms in the automobile sector, dirty manufacturing, utilities, transportation, other manufacturing, and then it doesn't hold very many corporate bonds issued by the service sector. So you see that the ECB is sort of relative to the market underweighing the service sector while it's overweighing dirty manufacturing, utilities, and transportation. And so here, the gray bars is the emission shares of the various sectors. So you see, as a fraction of the total, what are the total emissions that the firms in these sectors make as a fraction of the total. And so again, you see that dirty manufacturing, utilities, transportation, they have a relatively large share of emissions, and services have that's a sector that is relatively clean. And so if your eye compares the blue bars with the gray bars and the red bars, what you see is that what the ECB is doing in its asset purchases, it's overweighing relatively sectors with high emissions. So it's overweighing dirty sectors. So what's the common view of how these asset purchases actually work? So the conventional view is that they work by reducing risk premium on assets. From finance, we know that the average return on an asset is the risk-free rate that has been quite low in recent times, plus a risk premium. So everything is about the risk premium. And these asset purchases reduce these risk premium. So the risk premium compensates investors for taking risk. And so the idea is that the business cycle is the main risk factor, and each asset has its own exposure to this risk factor. That's what's called in finance the beta of the asset. And so the risk premium is the asset risk exposure, the beta of the asset, times the market price of risk. So that's the total risk premium that somebody who's issuing this asset has to pay to the investor. And so what asset purchases do is they lower the market price of risk. And so the idea is that by purchasing assets, central banks take risk off of balance sheets by financial intermediaries. And so that makes intermediaries more willing to take risk. And so that lowers the market price of risk, and that thereby you reduce risk premia with a monetary policy. And so once you have lower risk premia on corporate bonds and stocks, you get more investment. And so that stimulates output. And so can these purchases be market neutral? As an economist, our definition of market neutrality is that a policy that would leave firms' relative costs of capital unchanged. So it only has macro effects. So you lower everybody's costs of capital, but you're not distorting the relative cost of capital. And so you leave market shares of firms in the economy unchanged. So you're not distorting market shares. So that would be, according to our definition, a market neutral policy. And so asset purchases lower market prices of risk. And so that reduces risk premia, especially for firms that have a high risk exposure, the high beta firms. Those firms experience lower risk premia. And so those firms benefit much more from the policy than firms that are safer. And so these asset purchases will not be market neutral, except under very special conditions. So you can basically assume that asset purchases cannot achieve to be market neutral. And so let me talk about recent research in empirical finance and how that is related to climate change. Investors are becoming more and more aware that there is climate risk. You see this in the explosion in ESG investing. That's the main development in financial markets, is more and more investors want to be investing in ESG funds. And so climate risk is becoming a new risk factors. And there's very recent research that shows that firms with higher risk exposures to climate risk pay substantially higher risk premia compared to other firms, even within the same industry, even compared to firms with the same characteristics. These firms that have higher exposures pay higher risk premia. And so suppose asset purchases by the ECB and other central banks were to focus on green investments. That would generate an impact because financial intermediaries would be less willing to hold assets that are more exposed to climate risk. And that would increase the market price of climate risk. That would generate higher costs of capital for firms with higher climate risk exposures. And so to generate such a shift, you would need a shift in the ECB portfolio. We saw that the ECB right now has a portfolio that is tilted towards brown investments, investments in firms that belong to dirtier sectors. And so this would require the opposite. You would need a shift towards greener investments. Doing that would increase the market price of climate risk and lead to a higher cost of capital for firms with higher climate exposures. So let me end with some ballpark numbers. The big question is, what can monetary policy do? What can financial markets do in the shift in the cost of capital? Do shifts in the cost of capital generate enough of an incentive for firms to adopt greener technologies? And so let's put in some numbers. Let's suppose you want to implement a carbon tax that leads to a price of carbon that is roughly $100 per ton of carbon. You can also put euros here. Suppose you want to achieve 100 euros per ton of carbon. And you're looking at the universe of firms and sectors there the emission intensities of dirty sectors being, for example, the energy sector, of about 1 kilogram per dollar revenue in the sector, to green sectors, for example, services which have roughly 0 kilogram carbon per dollar revenue. So how large would you need the change in the cost of capital to be in order for there to be impact? And so this again goes back to work with Papuzzi and Schneider. So the change there, we show that the change in the cost of capital is basically a very simple formula. It's the carbon tax times the emission intensity of the firm or the sector times the capital depreciation rate. So if you take the $100 number that we want to achieve for a ton of carbon times the 1 kilogram per dollar revenue, that gives me 0.001 times the depreciation rate. So you're looking at a change in the cost of capital of 10% times the depreciation rate of capital. And so the typical depreciation rates for capital are between 10 and 30%. And so we're looking at numbers of what we need to do in order to implement a carbon tax through financial markets is we need to change the cost of capital of the high emitters by roughly 3 percentage points. That's not a crazy number. And so here financial markets are helping us because investors are becoming sensitive to climate risk. And the ECB can help this process as well by increasing the market price of climate risk. Here, I'm looking at the change in the cost of capital. If you're thinking about the cost of financing other inputs of firms like labor, it's basically the same formula. You're just using a higher depreciation rate. So labor is not as durable as capital because you have turnover. And so you just use the same formula with a higher depreciation rate. How could you implement this? And so this goes back to what Isabel was mentioning, is just think, how is labor financed? Many firms use bank loans to finance their labor costs. And so what you would need is capital charges for bank loans that are higher when those loans are used to pay workers in high emission firms. Thank you very much.
Thanks a lot, Monika. A numerical example always helps to concentrate the mind. If I may say as a parenthesis, just what the question I would have to you is, what if you already had a carbon tax of $100 a ton, which we have in the EU? Would you go for 200? Now, Hans-Peter Grüner, from the University of Mannheim, who has come out with somewhat different views on this topic. Hans-Peter, the floor is yours.
Yeah, thank you, Daniel. Thanks for having me. It's good to be back together in a real room. I would like to concentrate on the question whether the ECB should engage in something that one can call green monetary policy. I briefly summarize, I think you're all familiar with that, the main arguments in favor. The first one is a technical one, just says that the ECB should take the risks of the assets on its balance sheet properly and consistently into account. And of course, this also holds for risks to profit that are related to climate change. I have nothing to object against that view. I think it's perfectly consistent. Then there is a second line of argument that is linked to the ECB's primary objective. The story here is that climate change can change prices of food, for example, that can lead to inflation, and that the ECB then has to prevent climate change in order to prevent that happens. Similarly, one can argue that that climate change can lead to financial frictions, and these financial frictions could impair the transmission mechanism, which is why the ECB would have to prevent that by engaging in some sort of green monetary policy. The third line of argument refers to the secondary objective in the treaty of the functioning of the European Union, that the ECB should help the European Union to fulfill its policy goals if that does not interfere with the primary objective. And related to that, you can then make the point that was visible both in Isabel's and Monika's speech on the externalities that are associated with some firms' activities, and therefore you may have to do something about the bond market. So The consequence of both lines of argument are basically that the ECB should somehow identify green and not so green bonds, give preferential treatment of some sort to the green ones, not based on the risks that they carry for the bondholders, but based on the externalities that are generated by the firms that finance their activities with these bonds. I think since Daniel told me that he's a very strict chair, I skip this slide and go straight to the next one. The problems that I see with the first line of argument here, and that would be the one related to the primary mandate. Energy prices, food prices, potentially affected by climate change. Well, that is, in the first place, these are relative price changes. Yeah? Climate change is a very complex phenomenon. It affects temperatures all over the planet at different points of time. Predictability about how climate change as a global phenomenon will affect European prices like 10 or 15 years from now is extremely low. Yeah? When you look at general equilibrium theory, you immediately see that changes of exogenous variable make it very hard to predict how price vectors are affected. And so I think even for the ECB as a very wise institution, it's going to be very difficult to know exactly what kind of dosage of monetary policy is required right now to do something about relative or prices or inflation 15 years from now. By the way, this is a very general problem. It does not just occur with climate change. It also occurs with policies regarding, it also concerns the ECB's response to what one can call an energy transformation. There as well, relative prices are going to be concerned, but it's very, very difficult to calculate the ex-ante, the impact on inflation. Second problem I see, and that's related to Daniel's question about how can we measure success. The ECB is not the only player in town. The global climate is not just affected by Europe or the ECB. There are other European countries. There's the US, Russia, China as large players. This raises problems of coordination. Now, I can't go into details of models. I can tell you one model I think that fits pretty nicely when you think about the tipping point problem in as far as the climate is concerned, is that you end up in a Nash demand game, and the Nash demand game has some very nasty equilibria when you have too many players. Yeah? So adding players to a policy problem is not always a good idea. Sometimes it's a very good idea to give one problem to one player. Blurred responsibilities, that's exactly the point that Daniel made. When you're not doing that good on inflation, maybe you can say, well, but have a look outside, the climate looks good today. Yeah, I think it's much better to give one institution one objective. Little accountability when responsibilities are blurred. Third problem, precedents. War, like climate change, has the potential to affect price stability. War has, like climate change, the potential to affect financial stability. So if that holds for climate change, that the ECB has to prevent something from happening, should the ECB try to prevent war by, for example, going short on specific government bonds, and here I mean not reactively, yeah, but as a preventive measure on bond markets, commodity markets? For me, the answer is clearly no. No, because this necessitates a lot of judgment, and the problem is the ECB lacks the democratic legitimacy for that kind of judgment and activity. Fortunately, there are other actors who are perfectly legitimate to do that. So there is no need for the ECB, both for climate change and for prevention of war or any other things. Let me come to the secondary objective. So we all know the text. Without prejudice to the objective of price stability, the ECB shall support the general economic policies. Now, when we look into these general policies according to the Treaty of the European Union, indeed we find protection of the environment, so it's a good point from a legal perspective, but we also find many, many other things. Combat social exclusion, protection of the rights of the child, many noble objectives. But actually, if you really want to do all that, you will have to need to build a second tower in Frankfurt for all the employees, and maybe a third one if you really take everything seriously. Yeah? So you can already call the architects in at Himmelbau. Fortunately, I think there is no need for you to do that. Basically, because I think that it's very likely that going for a green monetary policy along the lines, manipulating what you do on the bond market may be incompatible with the priority for price stability. Now, I can't go into the details of a model here. I just want to give you an intuition of what I have in mind. Whenever you buy a bond, you don't know exactly what that is going to do to that specific market and to other markets. Yeah? So there is some uncertainty associated with the policies that you undertake. I think that's your business as a central banker. You never know exactly what's going to happen if you push one button. So this is exactly why you want to push multiple buttons at a time, because that reduces the risk that you get it wrong about the transmission of your activities. But of course, if you just discard some of those buttons, then it's going to become more risky. And I think that holds for green or brown bond purchases, and it holds also for other activities that you may have in mind if you want to enlarge the scope of the ECB's activities. There are, of course, also conflicts of interest that arise, and in a way, Isabel, you addressed it properly when you said that that this is climate change is a long-term thing, and monetary policy has to react short-term, and then conflicts arise because maybe you want to buy some specific bonds in order to address a climate problem, but on the other hand, it may not be appropriate from a monetary policy perspective. One thing that crosses my mind is that you're sitting already on a huge bond portfolio, and one may ask the question, do you want to restructure that because you want to do something for the climate? That's an issue that I have not heard about, but it would be interesting to see what that yields. That kind of thing could trigger inequality in the way in which you treat greener and browner economies and countries, and that would be a very topical issue, I think, in European politics. I think I don't go into the details of correction of the ECB corporate bond portfolio just for time reasons. I would just like to mention that, of course, the CO2 tax is something that is an instrument that can directly address the problem of emissions and externalities that are associated with specific companies. I would like to conclude with a general remark of what I observe. I've been around. I just counted with the ECB as a visiting researcher for 20 years. First time with Ottmar Issing 20 years ago, and so I feel like a friend to the institution. And as a friend, I would like to make one general remark about the development of the institution. What you see here is, in a way, the architecture of economic policy making according to the Maastricht Treaty. There is a central bank that is in charge of price stability. There are national supervisors in charge of financial stability, national policies in charge of growth, and rules and market discipline in charge of fiscal sustainability. Now, we all know that this system has completely failed. Yeah? And what we had to do over the last, 14 years is we adjusted the system overnight, over the weekend. We created the ESM and other fancy things from the fiscal side. But the most important adjustment was that the ECB enlarged the scope of its the range of its instruments. You all know the abbreviations. Of course, they are all targeting price stability, but as side effects, they also target fiscal sustainability, or they affect fiscal sustainability. This arrow here is about the ESM conditionality. We have now the supervision with the ECB, and now you are ambitious and want to add another field here, global warming, and want to handle that as well. So in order to visualize my concerns, I changed the color of the institution a little bit. Yeah? And when I saw this, it kind of reminded me of an octopus. Yeah? And so it's a wonderful animal, of course, yeah, an octopus. A complex one. So the last thing I would like to share with you is some ideas why I think it's not a good idea to turn the ECB into Europe's policy octopus. Why isn't it a good idea? Coordination. So as a human being, I mean, I have like 2 legs and 2 arms. I can handle that somehow. But 8 is a lot. Yeah? And maybe for an institution like the ECB, it's also just too much demanded to coordinate all that. Yeah? It also affects your communication. If you target like several things, even if you have a ranking, it becomes extremely difficult for you to coordinate. Because whenever there's a shock in some area, people will ask you, well, what about your monetary policy stance from now on, since there is something happening at the climate that, regarding the climate that you didn't expect? Accountability, what I said, you can always argue, well, we're now at like 7% inflation, but look, we're doing very good at our green monetary policy. I think it's much better for accountability to keep it simple. Control. As long as I know you guys personally, I'm very happy with you running that show. But if at some point you're replaced by somebody else, Isabel, I might get scared of that animal as a voter. And others may as well, which will ultimately risk your independence. So my message, my suggestion is just keep it simple. Make clear what you stand for, stick to it. And this is particularly important in times of high inflation. Thank you.
Many thanks. So you have seen different points of view. It's always a good sign of a panel if the first speaker feels challenged and would like to have some quick reaction, and then I come to the first 3 questions.
So thank you very much to Monika and Hans-Peter for very interesting presentations. I don't think I have to say much on Monika's presentation. I mean, I'm a big fan of her work on this issue, and we've used it a lot. And I think it helped a lot to bring the debate forward. So I don't want to comment on that. But of course, I want to respond to Hans-Peter, who, as many other critics on this point, I mean, is fighting a straw man. I mean, are we doing climate policy? No, we are not allowed to. There is a principle that is called institutional balance, which says we are not allowed to autonomously do policies that are, I mean, except for our price stability. So this is simply not true. We are not doing that. What are we doing? So we have a primary mandate, price stability. This primary mandate is affected by climate change in many ways. I mentioned some arguments in my speech. There are, of course, many others. I mean, there is, of course, an important impact on monetary policy transmission through the impact on financial risks to the banking sector. There could be an impact on our star. There is an impact on the types of shocks that we are facing. So there can be no doubt that when pursuing our primary objective of price stability, we have to take climate change into account. So no doubt about that. This is not what you're talking about, I guess, anyway. So then we have a secondary objective, and that includes environmental protection. In our monetary policy strategy review in the part on climate change, we focused more on the primary objective, but of course the secondary objective also matters. What does it imply? First of all, I think it's important to stress, and you also said that, Hans-Peter, that this is always without prejudice to our primary objective. That's, of course, very important. But the important implication of the secondary objective is the following. If we have the choice between 2 different policy options, and one of them, and both of them are equally effective with respect to our primary objective of price stability, but one of them is less aligned with the secondary objectives, then we are obliged. This is not a choice. We are obliged to choose the one that is more in line with the secondary objective. In this case, the green option. What does it mean? This means that we should try in our monetary policy framework and basically in everything we do to be Paris aligned. This does not mean that we are making judgment of what has to be done in order to promote climate change. We are following there completely the political guidance that is out there, which is Paris alignment. And this is what we are doing. This is not autonomous policy making, and we would not be allowed to do that. There are, of course, limits, clearly. And Hans-Peter mentioned some of them. So, if, from a monetary policy perspective, we have to tighten our monetary policy stance, of course, we cannot say we don't do that, because that would mean we can buy fewer green bonds. And we would not do that. Who says that we would do that? We would not do that. So, I think the limits are very clear, and we are sticking to the limits. If there is a limited supply of green bonds, then obviously it's not possible to shift all our asset purchases to green bonds, because then it would no longer be possible to choose the monetary policy stance that may be needed in light of the inflation outlook. I mean, these kind of things are perfectly clear. And so I really think the criticism is completely exaggerated. So, on your point, carbon pricing. You could say, I mean, as an economy, I mean, we are facing a situation of market failures, okay? Carbon pricing is the instrument of choice to deal with this market failure. Any economist would agree. But we cannot, shift to the optimal carbon price immediately, because the social welfare costs would be very high. If we don't have the infrastructure for different types of transportation, let's say, then an immediate switch is extremely expensive and also politically probably not feasible. So this is a gradual process. This process can be accelerated if all the investments are taking place that are helping us in the green transition. For these investments, financial markets play a very important role. And as a central player in financial markets, of course, we also play a very important role here. We have to see there is a high degree of urgency here. We are facing a problem that is irreversible. So all the carbon emissions that are still taking place, I mean, they're not going to, I mean, broadly speaking, they're not going to disappear. They are there, and the problem is irreversible. And therefore, this is the reason why all policy makers have to take climate change considerations into account within their mandate, clearly within their mandate, and our mandate is very clearly specified, and I can promise to you we're sticking to that. Thank you.
Thank you very much for that spirited defense and reply. I think it's always useful, it enlivens the discussion a bit. Now we tone down a bit perhaps, and we come to our three lead questions. And in the meantime, can I ask the people who are following the questions which are coming in online to tell me? Okay, good, it will come. Sorry, I didn't want, okay, good. They are all on my left hand here, I think on the right hand seen from you. Ulrich Carter from Deka.
Well, thank you. Well, I would like to stick with this issue of impact of green monetary policy. As we have learned, there's no place for greenflation in the inflation target. There's no support for a kind of green fiscal policy. The share of the ECB in the corporate bond market in Europe is relatively limited also to support the green bond market. Green TLTROs are not in sight. Would the panel agree that the impact and the possibilities of monetary policy to reach those climate goals are relatively limited? And especially, would you see a big difference to the impact of the private financial sector movement of the ESG investing? Is there a possibly a greater impact to expect?
Thanks a lot. If the other two questions are different, then if you allow me, I would like to have a very quick round of the panel right now, and then I come to the second lead question, if you agree. Okay, perhaps we go with Monika first. Monika, would you like to reply?
If you look at the numbers that I showed you, what the ECB has been doing so far, it's basically the opposite. So it's been the opposite of an ESG investor. And so I think it's very useful to think of the secondary mandate and to push the portfolio towards greener investing, because together with ESG investing, you can have an impact. And so this is why I showed you the ballpark numbers. You don't have to change the cost of capital of firms with high emissions by very much in order to have an impact like you would have with a carbon tax. And so this also goes back to Daniel's question about do we have a high enough price for carbon in Europe? So let me first say I'm from the perspective of the US, where there's no carbon tax. It's very useful to know that financial markets may help with this transition, so that you have pressure on companies because their cost of capital is now higher. And that comes exactly because of the question. ESG investing is putting pressure on these companies, but central banks can add to the pressure. And so it's useful to have that pressure in countries where there's no will to have a carbon tax, like the US. And in Europe, there is a carbon tax, but it's not enough. I mean, in terms of total emissions, Europe is not where it should be. Thanks.
Okay, thank you. Perhaps, Isabel, if you go first, and Hans-Peter can have the last in this round.
So thank you very much. Maybe I focus on the part that Monika has not yet answered. So I actually think that our actions in financial markets are complementary. So as I said before, of course, monetary policy is a cyclical instrument, and we cannot solve the structural issues. So in that sense, the changes in the private financial markets are much more important overall. But I think the central banks play a very important role as thought leader, as a catalyst to change. I mean, correct me if I'm wrong, but I would think that all financial market participants look very carefully at what the central bank is doing, and that this has an important accelerating effect on everything that is happening in the private financial sector. And in this sense, we are speeding up the transition, which to a large part has to come from the private sector.
So I tried to make this clear in my talk. For me, climate policy is a huge game with many players. And if one player changes his action, it's not really clear how the others are going to reply. Whether activity that is supposed to help the climate, whether this is like a strategic complement or a strategic substitute, like Gros versus Bertrand. So if the ECB does more, it's not really clear that others are going to do more as well. It could also be that they just look at the ECB and say, well, we have a strong actor now, and then they withdraw. And I fear the same thing about fiscal policy interaction. And so it's not clear at all that the ECB has any control here, because the ECB would first have to think about how its action, if they are really meant serious and not cosmetically, how the others are going to react to that. So I doubt that it's easy to control anything here. I would like to say one more word about the exaggerated critique. I hope you're right, Isabel. It's just that I'm not sure what you're going to do. I checked your website yesterday, what you're about to do, and it's not clear yet to me what you're going to do. And this is why I just put up the maximum critique that I can bring along, hoping that in the end you will disappoint me and prove that I'm wrong. And I'm very happy, like 5 years from now, to apologize if you don't do what I fear you're about to do. Yeah.
Okay, Volker,
so
you have...
Yeah, we meet here in 5 years. We see.
I wrote it down. And with my apologies to the very patient second lead question from Jari, Stehn, Goldman Sachs.
Yes, thank you. I have a question for Isabel Schnabel. So you argued in your remarks that monetary policy should not ignore the energy price and inflation effects of the green transition, but you also noted that monetary policy needs to be prudent because tighter monetary policy weighs on activity. And so my question is, how do you see this trade-off in the current context of the war in Ukraine, which of course is exactly pushing up inflation, but weighing on growth? And I think this trade-off can be seen quite clearly in the ECB staff projections in the severe scenario, which of course has much higher near-term inflation, but also weaker growth.
Directly? Okay. Thank you very much for the question. It's an important one. I mean, it's clear whenever we are facing supply-side shocks, we are in a difficult situation. But we are in an even more difficult situation if we have a whole series of supply-side shocks, and if we are facing very high inflation, and there is a risk that inflation expectations may become de-anchored. And so, and therefore, I mean, it's always a balancing act. And I think this also became clear from the president's speech, that we have to balance these different aspects in order to avoid, on the one hand, that we overly depress aggregate demand. On the other hand, we have to make sure that inflation expectations remain firmly anchored. And I think our decision last week reflects precisely that. And I mean, this is basically also the reason why we confirmed the gradual normalization process, because we have to take into account that this additional supply-side shock has a further impact on, or may have a further positive impact on inflation in the short term in any way, in the medium term we don't know precisely, and this is what we have to take into account there.
Thank you. I would now like to turn to the third lead question and then open it to the public, so prepare your fire, so to speak, and in the meantime, Thomas Möllers from the University of Augsburg.
First of all, I'd like to stress what I loved the discussion between Isabel Schnabel and Mr. Grüner about the role of the European Central Bank. I think our objectives are clear. Everybody needs to know that climate change is one of the goals of the 21st century. But the Green Deal program of the European Commission with the taxonomy regulation is a very expensive goal, because we created more than 2,000 rules, and now all the players have to fulfill the goals. We have transaction costs, and we have the greenwashing problem. And my question is, if you are looking for inflation and the Ukrainian war will perhaps increase the risk of inflation, should we also look for different ways in this environmental sector? We still have national markets. We don't have a European energy market. Yeah? One are protecting nuclear power, other don't do it. Now we have coalitions, because if we like to become independent of Russian oil and so on, we have to perhaps still go on with our traditional energy. So my question is, if price stability is your goal, yeah, should you also look for different areas? Because we have only one world, we should also perhaps look not only for the European level, but also look for a reconstruction Ukrainian with perhaps solar energy had been destroyed, and looking for good solutions is a goal. So my point of view is that the Green Deal incentive at the moment is too limited. But just looking for transparency and just looking that every company must fulfill duties, and shouldn't we also look for more efficiency by creating bigger markets in this our common goal in green energy?
So you're looking at Isabel, but do you have anybody else in mind? Okay, Isabel, why don't you?
Yeah, it's of course an American topic too, yeah.
Okay, then perhaps Perhaps, Isabel, you go very briefly first, and then Monika.
Yeah, I can be very brief because I can say that's not up to me to answer that question. And Hans-Peter will be very happy about that, because that's a political question. I mean, these questions are political questions that have to be solved. It's really, I would say it's not up to the central bank to take such decisions.
Monika, I presume you don't have a taxonomy yet in the United States?
No, and I can only confirm that there are decisions that have to be made by governments, by parliaments, and then there's other supporting actions that a central bank can do within its very limited scope of trying to achieve price stability. And so what I would like to again stress that we're talking about correcting towards a portfolio of the ECB that may look greener. Just look at what they have been doing in the past. They have been buying mostly assets from high emission sectors. So it's not like the ECB is already far ahead within this green investing mandate. There's not much progress yet. We're only starting to go in this direction. So I'm far less concerned, as Hans-Peter is very concerned about how far the ECB can go. Let the ECB go a little bit in this direction. It hasn't even, gone there yet.
Hans-Peter, will you let it go?
I would just like to reply. I think you have to ask, the right question, and from a monetary policy perspective, the right question should be, what is the optimal portfolio, the optimal bond portfolio that helps the ECB to have control of interest rates, inflation rate on the market? And if it turns out, when you answer that question, that the portfolio is green, so be it. That's fine, and I'm happy. But if it turns out that it's different, then for the ECB, it should be clear what it has to do. So I think what we shouldn't do is look at the portfolio from one particular perspective and say, now we have to restructure. Maybe another perspective gives you another portfolio. But I think what we should really care about is a well-functioning transmission mechanism. And I think your model is a building block for that. But if you really want to answer that question, you need some monetary side in that model. And then you can look at the trade-offs. I think that's the task, the research task that we should undertake. Yeah.
Thank you. I already have 2 questions on my very far left there, now 3. First, over there. I think, yeah.
Yeah, thank you. Thank you.
I think
yes, David Marsh. Question for Isabel and also maybe Monika. In terms of this question of measurement, whether we've got success, aren't we going to have to get the accounting profession involved in all this to a much greater extent that we have at the moment? Because as I understand it, accounts don't really make any kind of consideration for all the impairments that are coming down the line as a result of alignment with the Paris processes. And it seems a bit too simplistic simply to say this is dirty manufacturing, this is good services. It sounds a bit Orwellian, really. 4 legs good, 2 legs bad. And surely we're going to have a bit more differentiation here, not only for this question about whether the bonds that the ECB owns are good or bad, the corporate bonds, but to go much more deeply into this, also to prevent greenwashing. So getting the accountants on side in a way that maybe they're not at the moment, maybe the ISSB will have a role to play in all this, seems to me to be a great duty for the ECB.
Thank you. As usual, the public is now waking up, and I have already, I think, 6 people wanting to speak. Is anybody a question related to this issue? Okay. Yes, it is related. Okay, sorry. Now the lady in the 2nd row from the back.
Thank you. Hi, Mariam Mio from S&P Global. So I have 2 questions, but one is related to David Marsh. So I think showing that the portfolio from the ECB is brown is indeed a bit restrictive, because at the end of the day, who has to do the heavy lifting is probably the brown industries, right? Because they are the big emitters, so they have more work to do to transition. So maybe we need to look at it from this angle as well. But maybe you've done it already. And then I think, Isabel Schnabel, you mentioned that the green transition might have a positive impact on the neutral rate, but what about physical risk? So obviously there are those 2 things to look at, right? And maybe the physical risk impact of climate change would have the other would lead to a lowering of the neutral rate. So I'm also curious to hear your views on this. Thank you.
We make a quick round of answers, and then I go to the next wave of questions. Monika, do you want to go first?
In terms of looking at emissions is very restrictive. Of course, it's very restrictive because what we want to see is a lot of innovation of these companies, and we want to see that especially farms in dirty industries adopt technologies that are going to be greener in the future. However, we already know right now in terms of how the bonds and stocks of these companies are being priced in financial markets is that even conditioning on the industry that a firm is in, you have very large differences among firms with high and low emissions. So you look at their direct emissions of greenhouse gases, scope 1 emissions, they're actually quite well measured. If you compare across different data sets, data providers that measure these direct emissions for individual companies, they agree a lot. And so we do actually have quite accurate measures of how much a specific company is emitting. And those companies that have the higher emissions within an industry pay a higher cost of capital. So financial markets are already taking this into account. So in some sense, it is the right measure to use, is how high are the emissions now? And of course, then you want to provide incentives for the transition.
So the short answer to David is yes. And my answer to the transition question, so I mean, that is an absolutely crucial point. I would say it has to be taken into account. I mean, if we also look at Monika's work, I mean, of course, one of the main reasons why we are buying more of certain sectors is that these sectors are relatively capital intensive. So of course, different sectors have different characteristics, and it's perfectly right that those sectors that currently have the highest emissions have the highest need to manage the transition. And the question is how to take that into account. And Monika already mentioned this kind of like best-in-class approach, which I think is important. But also, I mean, there are now, of course, ideas to not just look at like backward-looking at emissions, but that you have a forward-looking component there. Of course, the data there is still pretty poor, but I mean, that's something that we have to live with in the hope that this is getting better over time. And I think there is a lot of dynamic in that market, and the accountants may play a role. So, and then finally, your question, you're of course right. We don't know precisely what's going to happen to our star. I mean, there are countervailing effects. Of course, there could be a lower productivity due to natural disasters and so on. There could be this investment boom that I stressed in my speech. I'm more on the side of thinking that our star is more likely to go up, but that is in the end we have to see.
Thank you. There were, I think, two further questions in that region of the world. First, over there. Yes, yes, you go, and then somewhat.
Hi, good afternoon. Michael Mayleys from Carmignac. It's a question for Ms. Schnabel. You mentioned in your speech and in one of your answers about interest rates in the normalization process being gradual. So the question is, first of all, what's gradual mean for you, Ms. Schnabel? And secondly, again, in a world of normalizing interest rates, we've had some concerns about accountability. Would there be a desire or perhaps the need for individual forecasts of what gradual is and what normalization is for the individual policymakers? Because I think we've had a lot of discussion about the secondary mandate. I think on the primary mandate, no one has any doubt on that. And maybe that would help to coordinate with other policies.
Okay. Can you repeat your question, your second question, the second part of your question?
The second part of the question was, in a normalizing environment, would it help to have dots or a summary of economic projections for the individual policymakers? Because in a world where we're very concerned about accountability, I'm sure on the primary mandate, everyone would agree that individual accountability is most important.
Okay. Well, I would say maybe these questions, maybe we can discuss them bilaterally, but this is not for this session, I would say.
Okay, Moritz Kramer, LBBW. I have a sense Hans-Peter's not going to like this question very much. It's mostly to Monika. So we're talking about corporate bonds here and what the weighting should be, but that's really a pretty afterthought. If you look at the balance sheet of the ECB and the APP, it's mostly government bonds. And governments, of course, have much more power to shape the path towards Paris through taxation, through regulation, and so on. So why would you stop there? Why would you not say, why don't we also reweigh the sovereign bonds in the public sector purchasing program according to the progress that they make towards climate neutrality? Because they are the ones that have the big levers in the hand. I can see political obstacles to that, but conceptually, do you have any reasons not to go there?
That's a slightly loaded question, but perhaps Isabel gets some time. Yeah, that's what I say. Monika goes first. And you
I get
not
the
despaired.
question. I completely agree with the intent of the question, which is you can look through assets and then assess what the carbon impact of the particular asset is, and that, of course, is also holds for sovereign bonds. And I think we need to think about how these purchases affect the climate, including with sovereign bonds. Also with bank lending, all sorts of involvement of central banks. How do they impact the climate? That would include sovereign bonds. In Europe, this is a very loaded question. In the US, this is a very different question because these are just states within a country, and so you can ask, should the central bank buy more of Californian bonds because California is greener than another state? That's an easier question to ask than should the ECB be buying more bonds of a particular country? So that those are difficult questions.
And the easy answer will come from Isabel. So the proposal is, instead of using a capital key, you use a carbon key.
Yes. So first of all, let me stress, of course, we do buy green sovereign bonds, right? So for example, under Next Generation EU, there is a lot of issuance coming that is green bonds, and of course we are buying those. And governments have an incentive to issue green bonds due to the greenium that I showed, that is actually likely to grow over time. I would say that us using a carbon key would be quite a difficult and quite political decision, which of course we will not do.
Thank you very much. I must ask the people in the room who are already on the list to be a bit patient, because we also had 2 questions here online. And I think you can read them yourselves. Actually, Isabel, if you don't mind, I would come up from the bottom. The bottom question is that actually central banks have had mainly more than one objective, right? Inflation and full employment, right? Could a central bank simply enlarge it successfully towards financial stability, EMU, and climate change?
Okay, there's a simple question, answer to the second question. So, I mean, the mandate is given to us by governments. So governments decide what our mandate is, whether it's a single mandate, a dual mandate, what role financial stability plays, and so on. And so that is nothing that we can change ourselves, but we have to take the treaty as given. And we have to align our actions with the mandate. So that's the answer to the question.
Thank you. And then there's this other question, what if corporate bonds, corporate green bonds have to be sold in the course of normalization of monetary policy? Apparently the answer is already given. The best thing monetary policy should do is not to buy corporate bonds at all. But let me perhaps rephrase the question, and comes back to something we have discussed, I think, several times here. How do you define a green bond? How do you define a brown bond? So let me take the bond of a manufacturing enterprise which is fully subject to carbon pricing, right? Is that a green or a brown bond?
So that's, of course, a separate question from the question there.
Implicit.
But no, it's a very good question, and these are precisely the issues that we are, of course, discussing. So on that question, so some time ago I gave a speech with the title "From Green Neglect to Green Dominance?" ? And there I discussed precisely what are the limits to what we can do. And one of the limits, and I actually already mentioned that before, is that, I mean, our monetary policy is guided by our primary objective of price stability. And if we need to reduce asset purchases or sell assets that we're holding on our balance sheet, the climate change considerations cannot be an argument against that. However, I could say that if, let's say, at some point we are selling corporate bonds, of course we could decide to kind of keep the greener bonds and sell the less green bonds. Because in the end, if we believe that our portfolio should be Paris aligned, I mean, this is a question about the stock. And so the stock should be Paris aligned. And currently, as Monika showed quite convincingly, the stock is not Paris aligned. And that would then speak in favor of selling rather the less green bonds than the greener bonds.
Monika, I presume you agree, but maybe you can add something on the definition of what is a green bond.
I would say you can always look at emissions associated with the production that is being financed by the bonds. And so there are measures out there. There are many different data providers that give you a measure for how much emissions are associated with the production. And so you can look at what the firm is that is issuing the bonds, and then you can decide for yourself what the what you want to define as a green bond. But it's clear that many companies in sectors like oil and coke, like the energy sector, they're going to have a hard time to produce in a green way. And so the broad measures already indicate what greener investments would be.
Hans-Peter, briefly, and then I go back to my list.
Just one idea on that. Just consider two firms, same turnover, one emitting twice as much CO2 as the other one. The first one, the high emitter has international competitors that are even dirtier. The second one has competitors that are less. Yeah? Now, the ECB targets the high emitter and makes it more difficult for that one to raise that. Basically, you push down this firm's activities and the other firms internationally take over and you increase CO2 emissions. So the problem with this is it's very difficult to identify what a green bond is because you would have to look into the market microstructure. And I think that's related to a very important general research question that we should ask ourselves and that you should ask yourselves at the ECB. The central bank is a macro policy maker, and you start to bring up more and more micro topics here, like is this inflation, is this greenflation, is this energyflation, or these words, yeah? But the problem is with the blunt instruments that you have in the hand of the macro institution, is it really a good idea to start to address these micro issues, or should one leave this to other institutions? I think it's a very general question that we have to answer seriously. And the example that I just gave, I think makes clear that sometimes you can have the very best intentions when you intervene at the market, but if you don't look at the global structure, you completely get it wrong. Yeah.
You want to react immediately?
Well, maybe just very briefly, of course, we have to leave that to other actors to decide what is more or less green. So we do need classification systems that are coming from others. There's nothing that we can do ourselves.
Thank you. And now I have one person here. Just make a show of hand who is still on the list. Okay, and then these two. First, why don't you go ahead?
I was a little bit, sorry, my name is Detlef Ramsdorf. I worked 20 years ago for the Bundesbank. Different times, different objectives, clear mandate, and of course, no politics. But I would like to ask Mr. Grüner, could you repeat all these secondary goals which they want to look at? I would like to know, is there a hierarchy also for all your secondary mandates? For example, you know, how many women you have on the board and how, what racism plays a role and so forth. And how do you weigh that? How do you differentiate that? Well, I found it a little bit funny if you have 5% inflation rate now to discuss heavily on all these other goals, which you also want to fulfill. But maybe, Mr. Grüner, you could give us again this. It was only shortly here to be seen.
I have to admit I didn't learn them by heart. That's why I had slides. But there was everything that is noble there, like that there was employment, social cohesion, territorial integrity. So many very important objectives. And I think we have to be serious about this. Frank Elderson correctly makes the point that the ECB has to check whether it's possible to do something along these lines, if in the sense that this does not interfere with the objective, the primary objective. So I think it's important that the ECB has, checks whether it is able to do something in these fields without prejudice to the objective of price stability, also because people can come to the idea to sue the ECB if that process is not performed properly. What I tried, the point that I tried to make is, I think the way in which one should do this is one should do the economics exercise and see what is best for the transmission mechanism. And if it turns out then that a certain result obtains, then we are done. And if we see that something interferes with that, we shouldn't do it. Yeah? So I think we should put this upside down and start with the question, what is good for a control over the transmission mechanism, and then everything else follows. Yeah?
Okay, Isabel feels the urge.
So just very briefly, I mean, one very important element of our policy making is proportionality. And when we talk about proportionality of our policy measures, one thing we always look at is potential side effects. And in the, in that process, many of the aspects that are mentioned in these secondary objectives, of course, also come up. I mean, if we have, let's say, certain monetary policy instruments that are particularly detrimental to equality, and so they create inequality, then that is an argument that we have to weigh when it comes to asking which instrument is the proper instrument. So, I mean, it's clear that this is a very complicated process, and there may, of course, these objectives may not always be aligned. And but you know, in the end, in the discussion, such questions do come up when we have the choice between different instruments. We also look at their various side effects, and these are, in the end, linked to the secondary objectives.
That would have been the ideal point to close, because we are right on time now, but I have the permission from Boss Volker to take the last two questions.
Thank you very much. It's not a question, probably I got something wrong, and it's probably just a question, a request for clarification. Ms. Schnabel, you probably meant something different, but you said the mandate comes from the governments of the ECB. And this is probably something that you didn't mean, because we all know that it is based in the treaty, and to amend it and to change anything about the mandate would mean that all the parliaments of the member states would have to agree, would have to pass that by law, would have to have a ratification on that process of amendment. So as a lawyer, I was just thinking, hold on, don't get this wrong, because it's not so easy to say, hi people, there's something which would be much better, and everybody has an idea, yes, that's probably correct, and for the time being. But in the long run, I would suggest to keep that in mind, that to major amendments, we need a very strong ratification process, very difficult process, which for the time being, frankly speaking, I don't see any majority. Thank you very much. Do you agree with this?
Yes. Okay. I think a point is taken.
Did I say the ECB's government?
No, the governments. Oh. Right? It's the people of the EU, right, via the treaty. Right? The last question over there.
So it's Christos Kolovatianos from University of Luxembourg. I'll be as quick as possible. What I find as extremely constructive here in this session is this fresh breath of general equilibrium and microeconomics, because it speaks about incentives. Every time we put a carbon tax, we internalize something that private markets cannot do. So the way I understand monetary policy in this is that monetary policy tries to internalize, as a lender of last resort, an externality that private financial markets cannot do. So here is first question to Hans-Peter Grüner. You mentioned about uncharted territories, expectations operators, we don't know. So essentially here, perhaps there are moral hazard problems, right? Like inviting excess risk. In Luxembourg, we have done a lot of that, and greenwashing. So I guess, this is quite constructive to think about, because we want to achieve the goal. And the second thing I think you really say is that when you put this goal, there is a contradiction. You will sacrifice some of the clarity of monetary stability, financial stability. So in this sense, we have to be very, very careful. So essentially, my question to Isabel and Monika is, do we need to sacrifice some of the financial stability in order to achieve this goal of involving private markets by essentially internalizing these things that private financial markets cannot internalize?
This is the closing round. I propose we take the opposite sequence, and if you could be very brief, Hans-Peter first.
I'm very brief. Of course, moral hazard is everywhere. So, of course, if you classify those bonds, there will be attempts to green. I mean, they are already there, and of course, also even more if the ECB provides the proper incentives. I think one should just, as I said, keep it simple. A CO2 tax is the appropriate instrument. It addresses the inputs of production. Finance is somehow linked to that, but I think it's much clearer and much more targeted to just go for the inputs. Yeah.
Thanks a lot. Monika?
I think all economists would agree with Hans-Peter that a carbon tax is the most efficient instrument to address the issues, but I'm super pessimistic that the world will agree on a carbon tax that will achieve what we need. And so I think it's very, I'm much more optimistic that financial markets and the taste of investors are going to achieve this goal together with central banks that are supportive. And so here I really view the central bank as a secondary actor. The primary actor are private markets that are, thank God, developing a taste for green investments. And that technology of private investment funds who are collecting data of what these firms do. And of course, there's going to be greenwashing, of course, but at least we're going to have some measures of what these firms actually do. And the private market will collect this data, and then central banks can use that information to guide policies as a secondary objective towards these investments. And so I view this as a very small secondary aspect of central banking, and it's supporting a massive enterprise that is private.
It's interesting that from where you sit, you are so pessimistic about carbon taxes. We are sitting here in Frankfurt, part of the European Union, which has important carbon taxes. So that should make Isabel also more optimistic.
So let me say first that I support everything that Monika said. I would like to repeat one point, which I think is very important. So our climate change considerations will not blur our primary objective of price stability. This is simply not the case. We have a hierarchy of objectives, and price stability remains our primary objective. And everything that is related to climate change can only happen without prejudice to our primary objective.
Many thanks for everybody for this very spirited discussion.